brokers that are basically gray market or black market kind of street brokers for dollars. And so people can still get their hands on dollars if they're in a repressed environment. But the liquidity, like if you're a billionaire or a multimillionaire trying to move around.
Hello everyone and welcome back to Finance Wolf. In this video, Lyn Alden talks about cryptocurrencies and Bitcoin. Bitcoin as well as stablecoins have significant influence. The use of tools in combating this issue can be particularly effective in developing nations. For example, people may prefer a Nigerian graphic designer who can easily present a QR code during a video call or send a payment via email or direct message. This method offers immense value and operates on a peer-to-peer basis, bypassing the local banking system. Holding and transferring assets is crucial in this process, and it is essential to consider jurisdictional risk. Lyn Alden covers a lot of topics, so please watch the video through to the end, like, share, and subscribe to our channel, Finance Wolf.
A lot of money, it's a lot harder than someone who's just kind of small and well connected. So a lot of what they do is they damage the liquidity of those things. But it also does draw attention to it. And so and it also kind of weakness feeds on weakness. And so, for example, if a country implements capital controls, well, every outside investor is like, why would I ever invest in that country again? Why would I ever? I'm not going to put money in. I'm not going to get it out. And so you can actually go into a spiral until eventually something changes. Now, an entity like the U.S. or China can get potentially away with more capital controls than, say, a Turkey. Right? It's kind of the bigger, more powerful you are, you have a longer runway of being able to implement that kind of thing. Now, the U.S. has the benefit of, fairly independent court system, so it's hard to just kind of do like a top-down thing. That political polarization can start to work on your favor because political polarization prevents some of the most extreme outcomes as long as it holds. So, for example, during the gold ban, one party in Congress had a supermajority. They had over 2/3. So they could bypass almost every check and balance because you had a gigantic wave of political shift. Whereas it's much harder to do those things in a polarized republic, for example. Generally, authoritarians can do it, or republics where they've managed to build some sort of narrative or some sort of supermajority. Those are where you get usually those more extreme outcomes.
Lyn, the typical watching.
So it's certainly important for some sectors, like I mentioned, commercial real estate, for example. That'll really be impacted by whether or not the Fed chooses to cut or not. My base case, but overall, I think that rates are a less important variable than the markets become accustomed to in recent decades. And so my base case is we'll probably see a steeper yield curve, either from higher long end on the bond yields or some cuts on the shorter end, or both. So probably steeper yield curve. So I'm not particularly bullish on, say, owning long duration bonds. If I'm going to own any of them, I'd rather own short duration ones or kind of mid duration ones. But the thing I watch at the Fed right now is liquidity. And so their rate of balance sheet reduction, I think, is going to matter because eventually they'll get to a point where they're no longer able to run their shrinking balance sheet playbook, because they run out of resources. Like they'll run out of reverse repos. They'll run out of other balance sheet space to absorb those bond issuances, and then they'll have to go back to balance sheet increases. And that is potentially a big narrative shift when they have to get to that point. I paid attention very closely when they back in 2019 had to go back to balance sheet expansion, and that was an investable thing. Basically, it was pro most types of assets when it happened. And so I think that liquidity variable, that balance sheet size variable, matters more than the rate variable. I also look at things like what's going on the fiscal side. Is there anything on the horizon that can accelerate some of the fiscal deficits, or is, for example, if a meaningful tax raise starts to make its way through Congress and is somehow going to get bipartisan support, that'd be a huge variable that I'd be paying attention to, as well as anything revolving around capital controls or anti-self-custody or these types of things. So those are the variables that I monitor in a fiscal dominant environment, or that I'm looking to monitor, that I have been monitoring more so than what's the Fed going to do at their next meeting. Are they going to go up 25 basis points or down 50 basis points or hold steady again? That becomes less relevant than Fed liquidity, fiscal deficit size, and any of these other kind of capital controls.
Lyn, this has been an absolute master impact here.
So I think what it looks like on the other side partially depends on how long it takes. My base case is to see a more multipolar world. So you asked before, for example, what does this look like for other countries? Well, it partially depends on how effective they are at getting out of the problem. So to the extent that, for example, China can buy oil in its own currency, allows them to escape some of the downsides of U.S. fiscal dominance than if they were stuck buying oil in dollars while the U.S. is running a fiscal dominance playbook. And so over time, I think you probably would see more kind of bilateral trade agreements between large foreign countries, other economic blocs. But I don't expect, for example, any one of those currencies to become larger than the U.S. currency. They're either, I mean, the only economy at the same scale of the U.S. is China, and they've closed capital, kind of on their border, and generally they're not a super trusted kind of global partner. And so it's not that one other big currency takes over, but that you have a little bit more diversification of currency pricing or what kind of reserve assets central banks hold. So you get maybe less treasury purchases and more gold purchases because that's a market that they're used to. It's pretty big. Over time, we'll see, for example, what happens to the size of the Bitcoin market in 5 or 10 years or whatever else is happening here. Stable coins are an interesting variable because even as you have top down, countries are trying to de-dollarize, at the bottom up, people generally still want dollars. That's kind of their fiat currency go-to. And so stable coins are a way to basically get dollars in the hands of people, even as their top level is trying to de-dollarize. So stable coins can actually extend the extent that the U.S. is able to maintain some degree of kind of global reserve status. And people can think that's good or bad, but it's just kind of a factor that potentially extends it in the face of that kind of top-down de-dollarization. And so that's all the kind of big moving parts there. But basically, it kind of shifts to a more and more multipolar kind of reserve asset and bilateral trade agreement world. As far as what assets to own, generally, where possible, you short fiat currency, if you could, especially if you locked them in before rates went up, and then you own things that are scarcer. And then if you want to avoid tail risk, you diversify because, for example, you don't want to have everything in one asset, and then your asset became the scapegoat that got like an 80% tax put on it, for example, right? So it's not about maybe the asset itself does fine, but maybe you in your jurisdiction don't do fine with that asset. And so you either pay attention to what's happening in that area, or you own, for example, you might own your own house. You might then own Bitcoin. You might own a little bit of gold. You might own some energy equities, or you might own various equities that have locked in long duration rates, and then they have variable pricing power. And that could be in almost any industry. And so you own kind of this playbook that can get through things. Maybe if you want to have if you're older and you want to have lower volatility, you own things like T-bills or intermediate term tips rather than owning long duration bonds. Those are all kind of the different levers that someone can pull depending on where they live. What is their volatility tolerance like? What is their willingness to kind of concentrate and take on risk of that concentration, which could come politically as well. But basically, yeah, you want to own scarcer assets and be very careful about owning anything that's kind of just purely paper-based.
I think basically the Bankless listenership is disproportionately long on cryptos as one of those scarcer assets. And interestingly enough,
we tend to not invest in paper.
Yeah. Interestingly enough, Lyn, I think you just presented the most compelling case I've heard to actually diversify out of crypto, because my general impression is crypto does quite well during this era of fiscal dominance, being a scarce, non-sovereign asset. But actually, I had not considered that it could be scapegoated, and it could be subject to the 80% type of taxes that you're talking about. And I would not put it past the current U.S. government regime to do something like that. So maybe there's a case for diversification. But just a final ending question. Are we safe in crypto assets? And, I know you advocate a 3-pillar approach, and, you're talking about profitable equities and owning some cash equivalents and that sort of thing. But how do you think crypto fares in this whole fiscal dominance era?
So I think that, for example, Bitcoin and stable coins are a big tool against this, right? So for example, in developing countries, the fact that people can a Nigerian graphic designer could hold up a QR code on a video call or send me a payment string, an email or a DM, and have me pay her in whatever currency she wants, right? It goes around her local banking system, right? So that's a super powerful tool. That's one that's infinite value density through ports of entry, and that's infinite value density peer to peer rather than through these centralized gateways. So that is basically the biggest tool against this is basically holding those assets, being able to transfer those assets is super important, which is also why you have to pay attention to jurisdictional risk. So I think that, I mean, that's why part of my kind of case for being structurally long Bitcoin is this fiscal dominance environment. And then I do also pay attention to stable coins, especially in that kind of emerging world phenomenon, because everybody wants to go up the stack, right? So if you're in Turkey, you want dollars or gold or Bitcoin or whatever the case may be. If in the U.S. you have dollars, so stable coins are less of an issue. But what these technologies do is they allow people more freedom of choice in whatever country they're in. They're able to go outside of their borders and get assets or get monies that they can't get just purely internally. And so that's it's basically the biggest tool we have against basically complete kind of replay of prior fiscal dominance periods or the effectiveness of capital controls. And I think it's worth it.
After the recent herring incident, Bitcoin seems to have safely passed the potentially dangerous phase and is currently reaccumulation phase based on past data is currently underway. A crypto analyst recently provided an update on the cycle of the Bitcoin market, noting that the danger zone which happened when the asset makes corrections following a noteworthy event that has ended. Bitcoin saw a strong bounce from the reaccumulation range low support. The analyst also pointed out that similar danger zones have happened in past market cycles when the asset retreats on either side of the event in this cycle. BTC fell 23% from its peak price in mid-March to $56,800 on May 1st, possibly indicating the bottom of the PO having danger zone period. The analyst believes that if $56,000 was not the bottom, then this current pullback will have officially equaled the longest retrace in this cycle at 63 days. However, historical patterns suggest that the current pullback ended at $56,000 after 47 days. If this video was helpful, please like it. And please subscribe to our Finance Wolf channel. Thank you, and see you in the future video.